Good morning, everyone, and welcome to this session. Very excited about this session. We've been talking about doing something like this for quite a long time, and today, basically, we are gonna talk about how you can use MentorQ for really any trading styles, whether you are a futures trader, option trader, swing trader, if you trade zero DTs options, if you're a crypto traders, or even if you're simply a long-term investor that is trying to really turn complex information into actionable insights. This afternoon, we also have the FOMC meeting, so there's going to be a lot of interesting action in the market, so we're going to cover that later on. But basically, the goal of this session is really to help you understand how we can simplify finance so you can actually focus on what matters and not look at the noise, right? So today we're going to show you some really cool insights on what you can do within the MentorQ platform. The agenda for today, very easy. We're going to walk through each trading style, highlight the key MentorQ tools, and show you how to build an edge with data. So we're going to cover things like future trading, stock trading, crypto trading, options trading, zero DTEs, and position trading as well. Before we go into that, of course, what we believe is that the best trades come from data and not really opinions or emotions. So our platform really is tailored to provide you with institutional level analytics. For example, a lot of you are already using our gamma models, our quant models, and our volatility models, and turn those into actionable insights for any type of trading style. We are going to start covering our users that trade futures. So we're going to talk about futures trading right now. So let's go into it. So if you've been trading futures for a long period of time, you know, of course, what the challenges are. The futures market moves fast. There is a lot of leverage, and this can amplify both your upside as well as your downside. So if you don't account events that are happening, like today we had a big VIX expiration and we have FOMC, you could really be chopped out very fast. So a lot of the futures traders are struggling, and obviously we know how the stats are. The majority of day traders are losing money in the market and end up blowing up their accounts. So we're going to help you change that and understand how you can use data to be more successful. So the reason why most futures traders fail are very simple. Most of them use lagging indicators. For example, you rely on outdated technical tools like, for example, moving averages, MACD, RSI, and those tools are great to confirm your idea. But again, everybody's using those, so they are lagging, and they sometimes are not able to provide an edge, right? Because everybody's using the same data to potentially enter or exit the market. The second problem is really risk. So the lack of risk awareness. Because futures are highly leveraged instruments, a small move can actually wipe out days or weeks or months of gains, right? So most traders really are focusing on making money, but they are actually ignoring the bigger question, which is what happens if I'm wrong and what is my risk reward for that trade. And the third one is really not leveraging risk, and that cause your account to blow up. So without really understanding the volatility, the positioning, the leverage, you are overexposed, and you could have really a bad day, and you could erase everything that you've done over the past weeks or months. So market is dynamic. You cannot really use the same strategies that works all the time. So you need to be able to be flexible and be able to react to that. On top of that, one of the big trends we've seen in the recent years is, of course, the prop trading, the growth of prop trading firms, right? So on the surface, everything sounds like a dream. You're trading someone else's capital. You can actually start with a low amount of capital. You can scale up, and you can keep the profits, right? So it's actually a great model. But in reality, there is no free money, right? So prop firms are businesses, they're not charities. So they have really strict risk rules. So they can cut traders very quickly if they don't show discipline. and they profit from traders who fail the challenges. So let's really be honest there. So again, if you're relying on lagging indicators, ignoring risk, and you're joining a prop firm, this won't really save you, because you're going to actually potentially blow up your account and end up paying a lot of fees in those challenges to get back and trade, right? So the real hedge in futures isn't really about getting access to more capital, but it's about understanding risk, positioning, and the levels before you put on a trade. So now let's go over some of the pain points that futures traders struggle with. The first pain point is really identifying meaningful price levels. So too often, you're chasing candles without understanding really where the levels can be and where the real positioning sits. The second pain point is really trend exhaustion. So many traders get trapped fading moves too early or chasing trends too late because they lack, reliable signals or forward-looking indicator. And finally, risk management. Because futures are highly leveraged, if you don't really calculate your risk accordingly or your volatility, you could actually face really big losses, and that could actually blow up your account. And that's where kind of like we're trying to come in here. So we're actually trying to flip the script for futures traders. So instead of providing you with lagging indicators, we give you leading data signals. So for futures, whether you're trading your own capital or you're using a prop firm, you can actually start using option positions, which is actually a forward-looking sentiment indicator, and you can actually use that to increase your risk and understanding where you could actually position yourself. So the goal is really to provide you with clarity, structure, and to help you trade like a professional, like the institutions do. So you can know the levels, respect your risk, and execute with more confidence, right? And the goal is really to help you be more successful by leveraging a data-driven approach. So let's walk through a real-life scenario that really happens very often. So let's imagine that you're trading ES futures, right? And you wake up in the morning and you go through your usual preparation, and everything in your technical setup is flashing a buy signal. So everything looks great. Your moving average are pointing higher. The overnight session shows a lot of strength, and your price action can signal that there could be a potential breakout of your technical levels. So the story is really telling you that you should really go long, right? But there is a problem. If you only look at the chart, you're actually missing a lot of the invisible forces shaping the futures market. So here is what MenthorQ actually can show you before you take the trade. So let's actually look at ES. So we can show you that ES is actually approaching a big call wall or big call resistant level with a lot of gamma expiring today. That's a warning sign, and the reason is very simple, because when price moves into these large option strikes or option levels, dealers are forced to hedge, and they're actually going to hedge by buying or selling the underlying. So that can create a resistance right where you're looking to go long. So that can actually be already a first signal for you. Second, we can see our positive or negative gamma condition. So we can see if compared to yesterday, we have seen an accumulation of negative gamma, and negative gamma means that dealers are forced to chase price. So they sell on the way down and they buy on the way up. And this tends to amplify volatility. So instead of a smooth breakout, you're now walking into a potential whipsaw. So like maybe there's a pinning effect at that level, and maybe you see a lot of choppiness throughout the day. Third, we also have advanced model like our CTA positioning, right? So CTAs, we're going to talk about it later when I show you the dashboard. They are systematic funds that provide or remove liquidity because they actually trade by following technical signals. So they go long or short futures, and that means that if they are decreasing their positioning, then maybe there's not enough support to an upside move, even though your chart says it should be a breakout. So on the surface, everything look bullish from your strategy, but the underlying flows is telling you that the long trade can be fragile, so it can be risky. And this is the edge that we can give you. So you don't just see a chart pattern, you see a positioning landscape, right? So instead of blindly buying into resistance, you actually pause. Maybe you size down your long, and maybe you delay your entry until you see actually a confirmation of this big gamma wall being broken. Or maybe you can simply flip the script and look for a reversal trade. So the point is that instead of trading using lagging indicators, you're actually now trading with context. So you understand where the forces that drive the market, which are the option dealers, the systematic flows, can actually make or break your trade. So this is how you can actually trade with data. You can actually have better entries. You can actually stay away from bad trades, and basically you're literally mimicking the way professional trades. So just think about that. Professional traders, they don't look at charts. They look at positioning, flow, and risk, and that's why they are successful. So the idea is that we can help you bridge this gap and show you what the professionals are looking for in a way that you can actually make good decisions and being actionable. Now let's look at another scenario, and this time if you're trading Nasdaq futures, let's say that you normally trade one contract and your risk management is structured around the 3-to-1 risk-reward ratio. Your stop loss is around 30 to 40 points, and that's been working well for you over the past few weeks and months. So for the past few months, the market has been in a steady uptrend with low volatility. Your stop are rarely hit, and the moves are smooth, and you feel comfortable about the system. So this has been working for you for months, but then something changes, right? And you open the MenthorQ dashboard, and suddenly the picture looks different. The market is now in a negative gamma environment. The Q volatility score is now at 5, which signals a high volatility condition. And this is a very important information for you to have. And here is why. In a positive gamma regime, market makers hedge in a way that dampens volatility. So that's why your 30, 40 points maybe have worked for months, and the market will spin and volatility has been very low. In a negative gamma regime, on the other hand, the hedging flow flips. So market makers actually hedge in the same direction as the market moves. So they sell when the market goes down and they buy when the market goes up. And this tends to amplify volatility. So that means that instead of really a calm market with smooth swing, you can actually start seeing really fast move both to the upside and to the downside. So what does this mean for you, right? So you've been trading with 30, 40 points with a 3-to-1 risk reward. This means that this shift into a negative gamma positions means that your risk just increased without changing nothing, right? So the stop loss that worked for months in a negative gamma environment, maybe it's not gonna work, and it's gonna actually trigger your stop loss more often because this just creates noise. Your take profit target may not be hit in the same smooth fashion because those swings are actually wider and less predictable. So if you trade with the same size and the same stop, you're essentially taking on more risk than before, whether you realize it or not. So this is one of the most common ways that traders blow up, because they have static rule and they don't actually modify them if the market changes. So whenever you see something like this, then you could actually trade differently. You could actually trade using micro contract. You could actually trade with more stop loss levels and more take profit because the swing are going to be higher. All right. So now we're going to another situation that a lot of you are probably going to be familiar with. The low volatility trap. This is very common in the market. So the market has been calm for weeks. Volatility is low, and ES is actually going higher in a steady uptrend or a steady channel. Every dip gets bought. We see higher highs and higher lows. So this is the perfect trending environment for a trader. And obviously, you're having a lot of success here. You're confident, your trades are working, and your P&L curve just keeps increasing. But here's the trap. Low volatility kind of brings us sometimes a false sense of safety. So you start increasing size, you tighten stop because you know that the market won't move much, and you may even like um, trade thinking that everything is easy, right? But the problem is that, let's say that now you open up the MenthorQ dashboard and you see something that the chart didn't show. The option score is lighting up, moving into a bearish territory. Positioning shows that dealers are shifting into negative gamma, and implied volatility is rising quietly, even though realized volatility on your charts look the same. So this is a typical scenario of what we call the calm before the storm, right? So on the surface, everything looks stable, but under the hood, something is changing, flow is shifting. And again, this could be the beginning of a sharp move. So what happened next? If you ignore the data, you keep trading like it's business as usual, you size up, you run tight stop, and you're overexposed. Then the market shift. So like a headline, for example, like the event that we're going to see today, or like a flow shock or dealer adjustment triggers a fast move that really is not covered by maybe like a big event or a big news, but basically your stop are now being hit and weeks of profit are wiped out maybe in 1 or 2 sessions, right? And this is exactly how a lot of traders also blow up their accounts because they confuse low volatility with low risk, right? But those two things are not the same. So low volatility doesn't mean that the risk is low. Markets can look safe until positioning shift and make them fragile. So most traders don't look at positioning; they don't look at flows. So they might be trapped into an event that could actually wipe out weeks of profits. All right, so now we are going to go into the dashboard and we're going to show you some of the tools that we have and how you can use them for your trading. Please send any questions. We're going to do a quick Q&A after this session, and we're going to move on to the next type of trading. So just give me a second. All right. So the first thing as a futures trader, so if I'm trading futures, the first thing I do in the morning is come to my dashboard, and I basically would review the main index and ETFs. So if you trade, for example, on YES, you should probably look at SPX. If you trade NQ, you should probably look at QQQ. I always also monitor SPY and the VIX, very, very important, because that can tell you how positioning change across different assets, right? So understanding positions and understanding the data, very, very important. So the first step is looking at my gamma condition. So we mentioned that in positive gamma, typically volatility tends to be lower. In a negative gamma environment, typically volatility tends to be higher. So if I'm trading yes, I want to also make sure that SPX and SPY or QQQ and NDX are confirming the picture. So we see our gamma condition here. We can look at implied volatility versus historical volatility. So we can see that even though implied volatility is higher than historical, we're still in a very low IV rank. So volatility has been very low on the asset. Then I can also come here and monitor gamma exposure. We're going to talk about that in a second by looking at SPX. So I want to monitor if we see a lot of positive gamma or negative gamma building up on SPX. I also want to monitor my 0DTEs flow on SPX to understand if there could be potential interesting point here. So we see a very, very big gamma level there. We're going to talk about that in a second. And then I can also look, for example, at our matrix. We're going to show this, how to read this as well. But basically, I want to monitor within all the option chain, is there some event that I should be paying attention to? So for example, on Friday, 38% of gamma and 32% of delta on SPX is expiring. So again, as a future trader, I need to understand what this means, and I need to understand what could happen at the end of the day, because there's a lot of options that are expiring for that day. The second thing is now I can actually move into my future section. So on the dashboard, on the left-hand side, you can actually see the future section. So the first thing that I want to do is look at depending on what asset you trade. So we cover about 25 different futures. So let's say that you trade index future. You need to understand which is the contract that you should be paying attention to. So this week we saw the rolling. So this week is the last week of the September contract. We're going to start to roll to December, but actually the option market has already moved to December. So on the December contract, we see about 60% of futures options open interest and 49% of volume. So again, this is important because the levels are calculated on futures options. So if you are using levels on the September contract, still you're missing a big part of the picture because the market has already moved to the December. So click on December contract, we open up the futures dashboard, and then we can go over the data also on this. So we can also see that we are also in positive gamma on the ES contract, so that which is confirming our view. We also can see how positioning happens at different strikes. So we have a big core resistance at this 6,700 level. Our gamma flip point, which is our high vol level, is at 6,620. And then we have some negative gamma positioning lower, but our put support is all the way down at 6,200. You can also monitor the 0DTs flow. So here are the options expiring today. So you see there's a lot of positive gamma here. And for today, the core resistance 0DT is 6,725. So clearly, market is looking at the event for this afternoon and kind of positioning itself. And then, of course, you have all the other expiration there. Then you can also look at the matrix, and you can see how much gamma is expiring specifically on the ES contract. So here we have the ES option chain. This is looking at futures options, so not option on SPX, but actually options on ES, right? Very, very important. So we want to see if we are overall in a positive or negative gamma. So for the 22nd, we have some negative gamma positioning. 10% of negative jacks expires on the 22nd, and for the 19th, we have about 13% of gamma expiring there. So very, very key. So what do these bars mean? So the green bars indicate a positive gamma exposure, which tend to stabilize price and reduce volatility. The red bars indicate a negative gamma exposure, which can amplify price move and increase volatility. And those typically represent big market reaction areas that you should be paying attention. This is where dealers are hedging. This is where dealers will come in and basically very, very important. Let's go back to the matrix of SPX in this case, and let me show you how you can read this table. So this table is really a simplification of the full option chain of the asset, in this case, SPX. So you guys know how hard it is to read the option chain. There's a lot of information. There's hundreds of options contract, dozens of expirations. So it's very, very important that you understand how to read this table. So what this table does is really simplify what's happening at each of the option chain. First, we are calculating the total gamma, total delta of that particular expiration. Here you see the number of days to expiration. So you have our 0DTs, etc. And then you have three important columns here, which are the jacks normalized, DEX normalized, and open interest normalized. So by looking at the whole option chain, how much gamma is expiring for each of the expiration, how much delta, and how much open interest. Why is that important? Because after this date, 38% of gamma exposure is no longer going to be there. So the option expire, 23% of open interest is gone after the 19th, right? So very, very important. Here you can also see the change in gamma and delta over the past day. That means that at the close of yesterday, 69 million of negative gamma has been added for the September 19th expiration compared to the previous day. Overall, we've seen an increase of negative gamma positioning for a value of 332 million compared to the previous day. So again, this can give you some ideas on how is the market positioning themselves and how you could actually read that data. Then we can also go and look at this in more of a screening format. So if you click on our screeners, this is something that I always do in the morning. I click on our gamma screeners and I come here and I look at the highest change in jacks. This tells me the positive increase in gamma on different assets. So what's very interesting today, we've seen quite a big increase of gamma exposure, positive gamma exposure on VIX, IBAT, China, large cap. And then if we go back to our screeners, we can also see the highest negative change in gamma. So what does that mean? That means that more negative gamma has been added on SPX, on IWM, on GLD. So that can also give you some ideas of, okay, how is the market position compared to the previous day, and what are they doing? How are they hedging themselves, and so on. So that can become an interesting indication. The next step we're going to talk about is CTAs, right? So you can find our CTAs models here. These are going to be very important for futures traders. And why is that? Because CTAs are commodity trade advisor funds. Think about them as large hedge funds that are simply trading systematically, so using algorithms, by looking at technical setups and by trading futures, right? So we cover different types of futures contracts. So we have, our indices, bonds, currencies, and then you have your currency tables. So for those who are trading Forex, you can also look at CTAs on Forex or commodities and so on. And then you have the chart. So how can you read this data, right? Let's go into the main table. So first of all, we can see that CTAs have been increasing their positioning on both SPX and NASDAQ compared to the previous month, right? You can then go back into your chart and you can see the green line is the CTA's positioning, right? So how can you use this kind of data as a futures trader? This data should be used to confirm the direction of your trade. So let's imagine that you see this table and you see that CTAs are actually buying more futures than a month ago. And let's say that you are short, you want to short this. You're actually going against liquidity because the data is telling you that CTAs are increasing their position to the long side, to the upside. So by shorting the market, you're actually going against a large chunk of liquidity that has been added to the market here, right? So similar to that, you can also use that in gold, silver, crude oil, and so on, right? So very, very important. So CTAs, very key. Next, we can go back to our dashboard, and then I'm gonna pause for a second, and then I'm gonna answer any question that you might have. But the next thing is using our Q score. Why is the Q score so important? So the Q score is your barometer. It's something that can immediately tell you what's happening with the assets. So let's imagine that you've been on vacation for the past 2 weeks, or you haven't really been following the news. What can I understand from here? The Q score is our proprietary score, and is looking at option activity, momentum, volatility, and seasonality. So right now we are in a very bullish bias on SPX coming from the option market. So the option market is still positioned for an upside move. We can see it also from those charts here. The momentum is very strong, so we are actually at the maximum level. And for those who, if you want to learn more about this score, we have dedicated videos that can show you how to use it. And then basically, volatility is kind of low, so we are in a low volatility environment. We have no signal coming from the seasonality as of today, but we can also look at the signal coming from the option score. If we scroll down into the chart, we can actually see the historical time series of the Q score. In this case, we are looking at the option score. So take a look how predictive this data can be. When we see a shift in options positioning from very bearish to quite bullish, this is when we see the start of kind of this trend. Then the market kind of drops. Here we saw at the end of July, we went from a very positive positioning to a very negative positioning, and that's kind of like this downside move. Now we're moving back into a positive positioning, and then the market is now moving up, and now we are moving from a 0 score, very bearish, to a 4. And this is like the recent rally that we've seen, right? So understanding not only the value of the score, so just not look at just the number, but also look at what happened historically, right? What happened when the Q score went from 4 to 0 on SPX, and you can kind of understand why that is important, right? The next thing, so once you do this, once you get your bias, once you get your ideas, whether it's I want to go long, I want to go short, I want to trade with option, then we can go into our indicator, right? And I'm going to show you a couple of new things that are going to be available for you very soon for trading futures. So first of all, you have your end of day levels right here. We can look at different futures. We can look at different assets. You could also overlay that with your intraday levels, so you can actually convert intraday levels from SPX directly into ES or NQ, and then you could have your blind spots levels. So let's look at it today. So the market moved up and then dropped, and this was right here at BS7 and JAX2. JAX2, very important level. Let's move to NQ, for example. All right, so now we see BL4 acting as a strong support to the downside. The market is now moving up together with JAX3. So now we have an important gamma level and an important blind spot level. Then we have our core resistance. We saw the break, we retested, and then we went all the way down. So this level acted as a strong resistance, and then the market is now stalling around this JAX3 level here. So very, very important, right? So you can use that to potentially build your trading plan. We also have an interesting feature within the indicator. So let me show you here that you can use to actually create your trading roadmap automatically. So I could actually build my trading roadmap here. I could remove the drawing. And this is just going to help me create those areas where I might be looking to be trading in and out. I can reduce my ratio if I want to see more areas, more boxes. And then I could use this as a roadmap for the day on how to plan my trades if I'm trading futures, whether you're trading NQ, gold, etc. So here is what the indicator does. The indicator also allows you to convert levels coming from another asset, so QQQ, NDX, yes, etc. And here you can quickly create a trading roadmap. The new thing that is actually coming this week is our scanner. So we are going to give you the ability to now have real-time alerts on levels by using the TradingView infrastructure. So this is going to be released in the next few days. It's going to contain levels for the majority of assets that you would potentially look. So from ES to SPX to Max 7 and so on. These are the end of day levels. And then what you can do here is you're going to be able to also customize. So if you're trading stocks, if you're trading crypto, or if you're trading assets that are not covered here, you'll be able to upload levels right here. And this will allow you to get also alerts on those. You can also show our different data points. So we are actually going to be able to add our Q scores directly into the watch list. So here you can monitor the different assets in real time. Are we in a positive or negative gamma condition? What is the Q score of these different assets right here? You can add, remove, etc. You can also be alerted on any level. So if you want all of them, if you just want the major one, the primary levels, and you can also be alerted on breakouts or breakdown. Breakouts are breakout from the bottom to the top, breakdown are from the top to the bottom. So you want to be alerted when the price crosses from below to above or from above to below. Once you do that, you can actually come here, set up an alert, and this is gonna alert you on all these assets real time. So big, powerful tool available for you guys as of next week. me just stop here so that we don't get too alerted. And then the next thing, and then we're going to answer some questions. We're going to pause for a second. Let's go over the power of intraday data, right? So what I want to show you guys is an example coming from yesterday, and then we can also look at an example coming from today. So let's focus on yesterday, right? Yesterday, and I'm going to open up my QQQ from yesterday, and I'm going to move into the intraday section. And what I'm going to look for is our JAX difference versus end of day, or JAX difference versus the previous snapshot. What this is showing me is the change in gamma every 30 minutes. So every 30 minutes, we have a snapshot 14 times per day. So you can see the timestamp at the top. And then I'm going to go back to our 9:30 snapshot. So this is 9:35 at the open. How does gamma change compared to the previous day, right? So we open up with a very strong positive gamma, which is the opening price here. So we are opening up with a gap. We're opening up higher. But then what happens to the next snapshot? We're now going back into a lot of negative gamma piling up. These numbers are pretty strong. So then what you see between 9:30 to 10, you're seeing a strong downside move, right? Then you're moving up, and then the picture is kind of similar until kind of like 12:30 or 12. What happens at 12? We're here, 12 and 12:30, the market kind of bounced back up right there. So what's the takeaway from this? Like, always you can use this data to understand how flow changes throughout the day. And whenever you see shifting in positioning from red to green, which is from negative to positive, you can actually use this data to confirm your trade potentially, or to even like decide whether to take an opposite direction. So so for example, if you were short here, you could have exit when you saw the change in gamma. So you could have exit when you saw the change at around 12:30, 12:45, right? So this can give you an idea on how you can kind of manage the trade throughout the day. And then again, we can also look at it how it is with today. So I'm going to pause for a second, and I'm going to answer some questions. All right. Good question from Alex. Stay tuned. We're going to talk about volatility when we talk about option in a second. Gamma condition and gamma environment. Yes, same concept. And then another question. I use Sierra chart, but I really like this real-time scanner. Would it be available on the MenthorQ dashboard? So right now it's going to be available on TradingView. You can already set up alerts in Sierra chart, so you can actually do exactly the same. So you already have the capability to do that in Sierra chart, and on the other platform there is alerting capability. So in NinjaTrader, we do have alerting capabilities. In TradingView there will be, and then yes, depending on the trading platform, we will have that capability for sure. Very good question. Does an FOMC day like today affect the data? Well, actually, yes, because we're going to go over the data soon. So for example, if we look at another very important point for future trading, especially if you trade ES, look at the VIX. Always take a look at the VIX and understand what's going on in the VIX. So today we had a big VIX expiration. So we had about 80% of options on VIX expire this morning or expire today. So again, this is why you see this strong move as well. So a lot of that flow is also affecting this very strong move, whether you're trading ES and Q and so on. So absolutely pay attention to the data. We've been talking about this for quite some time. So VIX expiration this morning, FOMC this afternoon, very important for the data. So another question: how do you see gamma flip visible in the chart? If you open up our indicator. Let's take this out for a second. Always monitor the high vol level or high vol level 0 DTEs, which is here. So this level right here, this is kind of like what we call gamma flip point. So just monitor that level, or you can go back to the dashboard and see where the gamma flip level is, which is right here. Hold on a second, guys. All right, any other question? All right, next, we're going to move into another type of use case, which is stock trading, right? So stocks are where really most traders begin, but also where they can get stuck, right? So if you trade stocks, you've probably faced some of these challenges. One is chasing price without context. So you see a breakout, you jump in, and then the stock reverses, right? So you're getting chopped out. Then you obviously rely on headlines and hype. So you look at social media, you look at what's going on Reddit, you look at news, and then you're trying to get into stocks, but without really having a context. You're ignoring positioning and flows. So who trade stocks, they don't look at option data, they think is not relevant. But stocks don't just move on fundamentals, they move because of option hedging, institutional flows, and the change in volatility. So as a result, you have a poor timing in entries and exit, and that's where you're basically always buy at the high and always sell at the low, right? And also you're trading with emotions. So you are following emotions without having really a real context, right? So very, very important. So here is the reality. So most traders, they simply look at charts without context. Institutions, on the other hand, they look at flow, positioning, and risk, and that's what we're trying to come in. We're trying to fill this gap, right? We're trying to give you access to the same institutional tools that that big hedge fund managers or big asset management firms are using. So to succeed really in trading stocks, you need to have clarity on key levels. Where is the real support and resistance, not based on lagging indicators, but based on actually positioning, because option positioning can actually be a great sentiment to where the market is thinking the price would go. You have to be aware of risk, right? Are we in a calm environment? Are we in a volatile environment? Or are we in a steady uptrend? And then, of course, you need to understand how flows can affect the price. So where are big funds positions? Where is the market makers going to hedge? And what can happen if the price approaches this level? So without understanding this, you're actually trading just by looking at price action without context. And that's one of the key problem. So how can we provide you with an edge? So we provide access to option positionings and gamma levels. We have developed our Q score, and we're going to show you some examples on successes that we had, on how you can use it for trading stocks and other assets. We also now have swing trading levels, which are high probability of support and resistance zones based on flows, not just charts. And we also have full back testing results there. And then, of course, we now release some really nice volatility models like our VRP, volatility risk premium, and others like skew term structure. All right, so now let's go through some real life scenario, right? So you've all seen this before. Apple is reporting earnings today. The reports really is strong. All the headlines are bullish. Social media is buzzing. Everybody's screaming, okay, like you should buy Apple because it's going to be great for the future, right? On your chart, the price is going up. Every technical indicator says that momentum is strong, and you're thinking, this is really the opportunity I've been looking for, right? But at the bottom, there's actually an invisible layer that you don't see on the chart, right? For example, again, MenthorQ shows you a massive call resistance or call wall near the current price. That's not just a line that you see on the chart. That's actually dealer positioning that creates resistance. Implied volatility is overpriced, so calls are really expensive. So if you are chasing and if you're buying calls, you're actually overpaying and you're paying a higher price. And the Q score is shifting bearish, which means the risk is building under the surface, right? So everything looks great on the outside, but actually the flows are actually telling you that this breakout could be fragile. So instead of buying the hype, you adjust, maybe you size down, maybe you use a spread, or you just have to wait and confirm that we actually breaking through that core resistance or core wall. So the goal really here is to tell you that you're not just looking at the headlines, you're not just following what everybody's thinking without having a context. You're actually using positioning to understand what's going on with the asset. Let's take another example. So again, Microsoft looks boring on the chart. We are seeing a tight range, low realized volatility. Everything looks calm, right? And you might think nothing is really happening in here. I'll ignore it, right? But then you see the MenthorQ dashboard, and you see that implied volatility is going higher, even though realized volatility is very low. We are shifting into a negative gamma position, which is a sign that the market could actually amplify the moves, and the Q score is actually moving into kind of like a bearish territory, right? And this is kind of like the setup that trader miss. This is a quiet market that turns into a sharp move, right? So if you hold Microsoft and if you have that in your portfolio, whether it's a short-term trade or a long-term trade, again, you might not be able to react because you think everything is fine until you see a strong move to the downside or to the upside. So we can actually show you by looking at positioning how you can actually look at fragile environment, how you can be reactive and be prepared instead of waiting for things to happen, right? All right, now let's go, and then I'm gonna answer some more questions in a second, guys. Let me just give you, let me go into the dashboard again. All right. So now we're going to go through some example on how you can trade stocks with MenthorQ. So first, we're going to use Alibaba as an example. There's been a strong price reaction over the past few weeks. The first thing you want to look for is the Q score, right? As you open up an asset, Baba is an example, you want to see what's going on with the asset. So we know that we are very high on the option score. So the option is actually pricing an upside move. The momentum is strong, and we see a neutral volatility. No signal coming from the seasonality at this point. But very, very important, you can also go and look at the positioning, similar to what we did before with futures. You see that there's really no negative positioning piling up on Alibaba right now. You can also look at the matrix to see if we have positive or negative gamma coming in. And then you can kind of see the historical data. So how did the Q score perform historically? So let's take an example, right? So Baba has been trading at the around 100 level for months, like we were in a very consolidated phase until something happens about 2 months ago. So we went from a very negative positioning to a strong positive position. So we went from a score of 0 to a score of 5, and now we are at 4. So again, this change, this delta could have been a great signal of something is shifting in the option positioning. And then again, we saw this is like 30-40% move from the past 2 months. So we went from 120 to now 160. And I don't know what the price is today. We can look at that. You can also use the same thing on momentum. So this is our momentum score. It was very bearish on Baba until a few weeks ago, a few months ago. Now we are at 5, and this change in momentum also signaled the start of this really massive uptrend, right? Let's go and do a couple of other examples. So for those who have followed the news today, Lyft saw a 30% increase per market. I don't know what it is now, but we can look at the charts. So let's go into Lyft here. So there's a news. They have a partnership with the Waymo. So very great headlines this morning. The stock basically open with a gap. went all the way to $23, $24, and now it's trading at about 13%, right? So you open higher, now it's trading at 13%. So let's go back into our dashboard. So what can we get from here? So we are in a very, very high, strong option positioning. We are in a very strong momentum, and volatility is neutral, no signal coming from seasonality. But let's actually go and see the history, right? So again, the headline, you cannot you cannot forecast these headlines, but you can actually look at how the market could have positioned and could have given you some interesting signal. So here we were at the beginning, at the end of June, very low option score. We moved to a very strong 5 bullish score, and now we are very bullish here. So again, just look at this. This is kind of the start of a trend. We went then to a kind of downside move, and then we are now all the way up to $23 or $24. So this would have also been a great example of how things could have changed. To the downside, for those who are following companies like Salesforce, they're not doing great recently. They had bad earnings, and things are coming down a little bit. But here you can see that we're in a negative gamma conditions on Salesforce, low momentum, low option activity, low volatility. So maybe something is shifting. So we can go back and look at the charts. Right here, we can see what's going on. So Salesforce, if we go back to the 5 minutes, was trading over $300, and they recently kind of dropped down right here. So let's see if this opens up. But let's go back to the dashboard here, and let's go and see how the option score could actually have been very predictive. So first, strong move here, and we see this kind of like small trends that could have given you some interesting returns. And then we see a shift from really positive 5 to 0. This was the beginning of the first move. And then we have a second shift, and this was this massive downtrend right here. Then we see an upside move, and then here we see the strong uptrend starting. Then we drop again, and now we're back into kind of like a negative environment. So again, all these moves could have been leveraged by using the option score and the other scores that we provide. And again, very, very easy. Look at this momentum score, goes negative, start of a bearish trend, goes negative, start of a bearish trend. So this data, very, very predictive. The next thing you want to do, if we go back to our BABA example, is you can look at our gamma exposure. So you can see how the market is positioning themselves for different expirations. You can look at our net gamma exposure. You can look at the matrix, and you can see the gamma situation for the asset. Then we have our swing trading models. So we're not going to go into the details because we have a dedicated course and dedicated videos. But the idea of the swing trading model is to give you clarity on the levels that could be respected or could be targeted within the next 5 days. So in this case, we are seeing a lower band. We are in a bullish bias for BABA, and the lower level, so this could be a level that could signal a potential start of a downtrend, would be 150.88. Our target for the next 5 days is 173.54. Why is this important? Because let's imagine that you are playing this stock by longing or shorting. You also have some backtesting results here. So you know that over the past 120 days, which is 4 months of data, the lower band has been respected on 85% of the cases. So on 85% of the days, the price does not go below the lower band 5 days in the future, right? So you could use this as maybe a stop, and you could use that in different ways, whether you're trading directional or with option data. But also very important, the risk trigger. So the risk trigger has been respected on 80% of the days. So what does that mean? Let's say that you're long Alibaba over the next 5 days. If the price approaches 173, there is a big chance that the price could be rejected. You see how this was respected. So it doesn't mean that the price cannot go higher. But again, you want to play with probability. You want to understand the levels that can give you a better probability of success. So again, if you did a really nice long here and you're hitting this level, are you going to keep Are you gonna keep chasing the move? You're gonna look for a home run, or you're gonna take profit and manage your risk and manage your profit, right? So that's what this model is telling you. And we do this model on 5 days and 20 days, right? So this is the levels for the next 20 days. Again, 184 was respected on 79% of the days. So very, very important piece of information. The next thing we can do on stocks is looking at the skew. Skew is a very important indicator. It's telling us the implied volatility of out of the money calls versus the implied volatility of out of the money puts. And the model is trying to look if we are in a call bias or a put bias environment. What this means is that if we are in a call bias environment, market is actually pricing higher implied volatility for out of the money calls, in particular 25 delta calls. That means that they're willing to pay higher premiums to potentially position themselves on out of the money calls. So they might believe that the stock could actually have a stronger move compared to whether if we are in a put bias in this case. So the skew, very, very important. It can help you really understand how the option market is pricing for an upside move or a downside move. And then another very important model that we just released last week is the volatility risk premium. The volatility risk premium tells you the difference between implied volatility and historical volatility, but in an historical context. So today, VRP is minus 11.7%. That means that implied volatility is actually 11% cheaper than historical volatility. But what does that mean? Is this good? Is this bad? And what does it mean? So historically, you can see how the VRP has performed. So before the VRP was really high. Now the VRP is really high to down. So implied volatility is really underpriced compared to historical volatility. What does that mean? That maybe buying premium could be a better strategy because volatility is kind of really low compared to the history, right? And of course, that volatility tends to be a mean reverting indicator. So again, the VRP would tell you if we are in an undervalued IV situation or in an overvalued IV situation. If IV is undervalued, you have more chances of success by buying premium than selling premium because you don't want to sell premium when volatility is low. If implied volatility is overvalued, then maybe you have a better chance of success in selling options rather than buying. But we're going to talk about that in a second. And then the next thing, again, once we do our analysis and we want to go and trade, we can actually go and open up our levels. So let's do a couple of examples. We have one good one on Tesla from today. All right, so this is a good example on Tesla. So first of all, we now have blind spots level on Max 7 companies. So you can now actually use our blind spots level indicator on Max 7. We're going to do a couple of examples. This is really good because now Tesla broke through the put support 0 DTs, and you didn't have any gamma levels behind that. So there was no other levels. So again, how can you use data to potentially understand where the price could reverse? Again, we're using our blind spots. Blind spots 2 was exactly the point of when the low for the day, and now we are reversing there. So very, very important. You can now use gamma levels on Max 7 companies. Let's do another example on Apple. All right. So again, take a look at this, right? So we are now fighting around this core resistance level, right? This is a very, very big level that it's been hard to break for the whole duration of the day. So again, once you know that, and we are retested many, many times, this could have been a good example. To the downside, we had this blind spot 5 level here, very interesting. This could be a strong support area, but now we are really really fighting around this level here. All right. We can also then look at intraday gamma models, but I think I want to spend time in going through our screeners. So how can you, as a stock trader, find trade ideas for your preparation? So we have a section of the dashboard, which is our screeners. We have different types of screeners. So for example, let's say that you like trading our gamma levels. You can actually run our core resistance, high vol level, put support screeners. These are end of day, so they're calculated at the end of the day. So this tells you the stocks that as of close of yesterday, they are coming close to a gamma level. So we have match.com, we have XLE. I'm going to show you something that is really interesting that is available on TrendSpider. So for those who are actually using the platform, you can actually do now intraday real-time scanning. So I could actually come here and I could say, okay, I want to see all the stocks that are now approaching your high vol level and high vol level 0T. I can quickly scan. This is all integrated via API, so you have access to all our coverage, all our data. And now I can quickly go through each of the stocks that are 0.5% away from the high vol level here. And I can see immediately on the chart how the price could react. So for example, if I'm looking into it and I would love to basically trade off this level, I now have an intraday real-time scanner that can give you that. You can do the same thing for put support, 1 day max, 1 day minimum, or any of the other levels. So in this case, like I'm looking at companies approaching my put support. So now you have Boeing, has been trading around this area. So again, real-time scanning through our data using the TrendSpider application. Now we have CRM again. We are approaching put supports. Again, look at how the price bounced back and forth through the level. Very, very easy to do that with the platform. This is one type of screener that we have. We also have open interest, volatility, and volume, but I think the most interesting one would be looking at the Q score. So again, with the Q score, I can look at, we've seen like how predictive the different scores can be. I could actually look at different types of analysis. I could look at the highest option score here. So here is telling me what asset have the highest score, a score of 5. So you see lift here, you see IBAT, etc. But again, if I go back, the other very big one is the change in score. So you want to see an increase or a decrease of the score. So if we are looking at the decrease, we want to see what are the assets that are seeing a big outflow of option activity from the previous day. So we've seen that, we've seen it here. We can filter out by highest option score. So you can see that Russell has seen a decrease in option score. Costco has seen a decrease in option score. CRM, NVIDIA, Microsoft, etc. So this can give you some really interesting idea for the day, and they're all available right here. So we have multiple screeners. All right, so I'm gonna pause here, and then we're gonna move on to the next section. All right, before we go into that, can you show Tesla? Yes, I'm going to go over Tesla in a second when we look at options. Question from, so we've seen, again, those changes in option and volatility can definitely be signals. So yeah, can definitely be signal. Again, we have an event this morning. We have a big event this afternoon. So the market is probably also protecting itself and reacting. So, okay, how many stocks and symbol can be put in the scanner? On TrendSpider, you can actually scan for the full coverage, which is about 1,300 stocks. Right, and there's a question, what do you mean by decrease in option flow? I mean really the flow going from positive positioning to negative positioning. So if you start seeing an increase in negative positioning, then that could be a warning sign. Yeah. Question, Sammy. We're gonna go over this in the next section. Yes, absolutely. All right. Right. So the next type of trading style that we're going to go over is options traders. Um, Options, in my opinion, are one of the most powerful tools that we have in the market. But it's also one of the fastest way to potentially blow up your account, because if you don't know how to trade options, you could actually lose money very, very fast. So some traders, for example, buy options hoping for explosive returns. Let me go to the next slide. And basically, but they end up overpaying for premium, right? So that's why we've built like our volatility models. Other traders sell options looking for steady income, but they underestimate the risk and they underestimate how volatility could actually change very fast. So the really truth is that most option traders don't really understand the flows that drive the option pricing, and that's why we want to show you some example today on how you can use that. So for people that are looking to buy options, so premium buyers, it's it's a very, very good way of trading because there's less leverage, there's more leverage, so you need less capital. But most of the time, if you don't understand how to read volatility, you can actually really lose everything that you paid for. So you can actually lose the full premium, and your option could actually go to zero. If you are a seller of premium, so if you are actually using options to get premium, and you love the fact that you are getting income, you could actually blow up very fast if you don't look at volatility spikes and if the market actually goes through your strikes, right? So in both cases, trader fails because they ignore flow, positioning, and volatility. Uh, some of the mistakes, again, we want to go over this pretty fast. But for people who are buying options, most of the time you're overpaying. So you're buying when implied volatility is very high. Um, you are buying into breakouts. So you're buying when we have strong gamma walls that are actually causing resistance. You can actually lose money because even if you get the right direction, but you're actually miscalculating theta or IV crash, you could actually lose money on your premium. This is what happened with the GameStop saga. A lot of investors were buying call option. The price was still going up, but they bought at the highest point of implied volatility. So then you still lose money on the premium. If you are selling options in a calm market, you might not be looking at how volatility can change. So you might be mispricing the risk because you actually don't look at dealers' positioning. So you're actually confusing premium with free money. And again, there's no free money. So most option traders, they look at charts and they don't look at option chain and dealers' positioning in details, right? Institutions, on the other hand, they look at big open interest data, gamma exposures, where is the market position. They look at volatility surfaces and they look at risk, right? So institutions are trading using data, and that's what we're trying to deliver here. So we're going to show you some examples. So what can we provide? So we can provide you with gamma levels. These are really support and resistance areas created by dealer hedging. We can provide you with volatility models, and we're going to show you some example today. And then the Q scores really can be your barometer to understand if the market is calm or if we are moving into a more volatile environment, and therefore adjust your strategy, right? So you don't want to sell premium when you are getting into a volatile environment or a too volatile environment, because that could go against your strategy. So the idea really is trading smarter using data and use the same approach used by institutions. So now let's go through an example. So let's say that you are bullish on Tesla. The chart looks great. We're going to go in and look at Tesla in a second. Momentum is strong and you buy calls, right? But here is what you can actually see from the MenthorQ dashboard. Implied volatility is at the highest, so you are overpaying for premium. Dealers are moving into a negative gamma environment, so the volatility risk is really high, and then of course you have a strong gamma wall ahead, so a strong core resistance, right? So again, this is a very big resistance levels that could actually turn against you. So as a result, Tesla moves sideways. Your calls are actually losing premium because you're losing time. So the theta decay is affecting your premium, and even if you were right on the direction, you're actually losing money. So what we're going to show you in a second with some of the examples is you can now understand if it's a good time to buy or sell option. Maybe you should use spreads instead, or maybe you just want to wait and you don't want to burn capital without context. The other example, and we're going to talk about SPX in more details. Let's say that you are an SPX iron condor seller. The market has been calm, volatility is low, and premium looks great. Like it's like free money, right? But hey, what about if you start seeing that dealers are shifting into negative gamma? The volatility scores goes from 0 to 5, means that we are now in a high volatile regime, and implied volatility of SPX is actually rising slightly as well. So on the surface, everything looks safe, nothing has changed, there's no headlines, but underneath, actually, there's fragility and there's a fear building up. So what happens is that you see a sharp move that goes through your strikes, and the income that you're generated is actually causing you a massive loss because you have taken too much risk, right? So your months of or weeks of profits are now at a loss because you had a bad day selling iron condors. Then let's look at another example. We're going to go into earnings. So when you look at Apple, an example, most traders do one of two things before earnings. They either buy call or puts, and when volatility is very high, and they lose when volatility goes down. So we normally have the concept of IV rush and IV crash, and we're going to have an event on Monday next week to talk about that, talk about earnings. So stay tuned there. Another mistake that traders do is they sell naked options. So this is also very risky. So always never, naked option carry a lot of risk. So be cautious when you do that. So let's imagine that you now open your MenthorQ dashboard and you see a steep volatility surface that shows that IV is overpriced. Gamma is positioned at around key levels, so there's a really strong probability of a pinning effect there, and obviously the flows are dampening the moves. So instead of gambling, you actually structure a smarter play, which is looking at credit spreads. You're looking to capture an expensive premium with controlled risk, right? So you're now trading with the data. You're not just betting or gambling on the outcome. So the message really to for option traders, for our users that are trading options, you as a buyer, if you're looking to buy, you need to look at stop overpaying for premium, especially if you see a fragile setup. If you're a seller, you need to start understanding the volatility risk. So we can provide you with the tools to do that. So with MenthorQ, you can actually look at when implied volatility is cheap enough to buy, when it's dangerous to sell, and how to align that with your strategy based on flow. So options are not just about direction; they're about positioning, flow, and volatility. And we're gonna show you how we can give you an edge on there. But before we do that, let's go back to the basics, right? So this is really in the basic theory of options trading. You want to sell option when volatility is high, and you want to buy option when volatility is low, right? You're going to have the more probability of success if you do this, because if you're buying option when volatility is high, it doesn't matter about the direction, your premium probably will lose because of the concept of theta decay and IV crash. So to do that, you could actually use a simple indicator that we also provide, which is the IV rank. So when the IV rank of a stock is between 70 and 100, that means that the premiums are pretty high compared to the past 1 year. So option selling strategies with more risk are better in this scenario. When the IV rank is from 50 to 70, then maybe you want to start considering lower risk strategies. And when the IV rank is very low, then selling options is risky because, again, the risk is that volatility will increase faster. So again, this is very, very short checklist. This is one indicator. We're also going to look at our VRP model. So please, guys, send me any question. I'm going to go into the dashboard now in a second. All right. So the first thing we want to do is when we analyze options or trade on options, we want to look at different things. So we're going to use Tesla as an example. So the first thing we do is we look at the Q score, right? And this, whether you're selling premium or buying premium, you also want to understand what's the best outcome. Is buying a put a good outcome now with Tesla, or is buying a call a better outcome with Tesla? So we see that, again, we are in a positive gamma environment, so like calmer environment on the daily trades, so the moves are less volatile. We have a very high option score, so we are at the top, so we are in a very, very bullish bias, and we are in a very, very strong momentum, and also seasonality is pretty high. The volatility score is still neutral, so we're not in a calm or we're not in a high volatile environment just yet, coming from the score, but now we're going to look at other tools that you can use for that. Then we move into the net gamma exposure chart. You want to look at positioning across all expirations, as well as positioning across the weekly expiration, especially if you are doing shorter term trades. And we can see that we don't really have a lot of negative positioning to the downside here. We have our put support at 250, and we have a strong core resistance at 450, but we also have a very big jacks level around 400 here, right? So those could be your levels for that. Then we also want to go and look at our swing trading model, right? So the swing trading model, again, we are in a bullish bias, right? And we have a lower band at 384, and we have a risk trigger at 458. So those levels could actually become your levels for your strike price for a spread or for selling options, if you are thinking that is the right strategy for you. So you can see the back testing. You can see that over the past 119 days, if you were to sell premium below the lower band level, you would have been right on 88% of the cases. If you sell above the risk trigger, again, the risk trigger was respected on 74% of the cases over the past 119 days, right? So that's very, very important. But now let's actually go and look at volatility. And we're going to start from this section of the dashboard, which is our vol models here, right? So we're going to start from here. We're going to go do some example on gold and silver and some other asset. So the first model, this was released last week, but it's very, very important, is our cross-asset volatility tracker. So what this does is comparing today's historical and implied volatility versus the 3 months historical and implied volatility percentile to understand if volatility today is higher compared to its history or it's lower compared to its history. So from here, what we can already see, we're going to focus on silver and gold, where we are seeing that GLD, implied volatility, and historical volatility are at the highest percentile here, right? So here we see that the implied volatility of GLD is actually at the highest it has been over the past 3 months. Okay, and then you can also look at other assets like QQQ, and you can see how these are positioned in the quadrant. Then we can look at, for example, the volatility risk premium. So we can also see that the volatility risk premium of GLD over the past year is actually almost at the 100 percentile range. So the volatility risk premium for gold is actually, or GLD, is actually very high, right? So now what we can do is we can go back to our dashboard and let's actually go into GLD. All right, so GLD, again, we look at the Q score, we're in a bullish bias, we look at the momentum, bullish bias, and then we can look at the new VRP model on GLD. So what this is telling me is that we are at the 98th percentile over the past 3 months. We were at the 93% percentile over the past year. So we are now almost at the highest level of risk premium compared to the past. So the risk premium is essentially the difference between the implied volatility versus historical volatility. But just by knowing the difference without context is not useful. So this model tells you how is the risk premium today compared to the past. So you're now seeing that you are in an overvalued IV stage. So you might think, okay, it's probably a good time to sell options, right? But before we go into that, let's go over all the different models. So you actually have our swing model here. So you have 331 and 347. But again, selling options alone could be also dangerous because we are looking at an asset that is a all-time high and there's been a lot of activity recently. If we look, for example, at the term structure, you see something very, very interesting that you didn't capture from the previous model. So you can see that the green line is the term structure from today, and the other lines are the term structure from yesterday, 5 days ago, and 1 month ago. So look at the structure of the term structure for GLD. We're seeing a higher volatility in the shorter maturities compared to the longer maturities, and we also have seen a shift in the curve from a month ago. So from a month ago, we were in a different structure. Now we are seeing like a completely different structure. We are now pricing higher volatility on the shorter term maturity compared to the previous one. So that means that the market is actually expecting a stronger move on GLD in the near future compared to the tail end of the curve. So again, that could actually put you in perspective and see, okay, maybe I want to sell options on GLD, but I need to be cautious because the market is also pricing a stronger move in the shorter term, right? All right, so this is really using, a bottom-up approach. So I start from an asset and I do the analysis. But with our screeners, we can also use a top-down approach. So we can actually use our screeners to potentially find trade ideas for option plays. So you can go on our Q score screeners, and you could actually go on, for example, our highest volatility score here, so you can see which of the asset have the highest volatility score. So here we have Costco, we have Goldman Sachs, we have ConocoPhillips, Pfizer, etc. So they have an option score, a volatility score of 4. You could also do the opposite, and you could actually look for low volatility score, or you could actually look for changes in volatility score. So who has seen the highest volatility score increase over the past day? So again, Pfizer, AT&T, and so on. So this can give you some really interesting idea. Within the option screener, you also have our volatility screener, so you could actually look at high IV rank, low IV rank, and again, formulate ideas based on these scores right here, and then use it for your trading. So I'm going to stop here, and then we're going to move on to the next kind of type of trader. Sorry, guys, if I keep you for so long, but I think this is very important. So let me know if you guys have questions. Let's see. Question, Indian market, not yet. Possibly in 2026, we're going to look at that. We don't have it yet. So we are mostly focused on European, and we're going to integrate, mostly focused on US, and we're going to integrate European market in the future as well. Right. The next type of trading style, so the next trader type is really zero DTEs, XPX traders, right? This is a very big part of our user base. And we're going to talk about one of the hottest trends in trading today, which is selling iron condors on SPX, right? Why is this so popular? Because for some traders, this feels like a dream. So you can actually have daily income from selling premium. You can do quick scalps with huge leverage, and there's multiple opportunities throughout the day. But the reality is that zero DTEs is a double-edged sword, and most traders, are getting chopped out and are getting they blow up their account because they underestimate what zero DTEs options are and the risk. Right, very very important. So if you sell iron condor, or if you trade zero DTEs, you both run in the same issues. Who sells iron condor is actually thinking that because we only have a certain amount of hours left to the expiration of the option, that actually selling premium is pretty safe until one move wipes out weeks of income. For zero DT traders that are looking for breakouts or reversal, they normally trade into gamma wars, and basically what happens if the move doesn't go in your way, if you don't see the breakout, your premium just loses value very very fast. Again, you're also, one of the biggest challenges that you're trading blind and you're not looking at the real forces that are shaping the SPX intraday flow and positioning, right? So you're focusing on charts and you're not looking at what's underneath, which is gamma flows, volatility changes, and so on. And that's why a lot of zero DTEs traders, they have maybe a few months of great setup and then they lose in a couple of days because they underestimate volatility, right? And this is what we actually can provide. So we actually have intraday, gamma levels, and end of day. So we have both end of day and intraday. So we can show you where the SPX will pin, stall, or break. You can actually use our Q score, and this can tell you if today is safe, fragile, or maybe dangerous. And then you saw some of our volatility models, and then you can actually look at those to understand if it's a good time to trade condors or trade SPX using a context, right? So let's make a very, very quick example. So you're an SPX iron condor seller and you sell iron condor every day. The market has been calm, volatility has been low, and you've seen an income like a steady income coming from premium. But then you wake up one morning and you are seeing that dealers are moving into negative gamma. The volatility score is now at 5, which is a high volatility regime, and then implied volatility is also growing. So again, you think it's just another day, and then you just want to sell your condor and take your premium. But again, one headline could actually cause the SPX to actually rip through your short strikes, and weeks of income are gone in a single session. So we can provide you with some of these tools so you can actually understand what's happening before you actually place your trades, so you can actually be more aligned with what's going on in the market. We also have intraday snapshot that update 14 times per day, so you can actually use that data as well. The other scenario, it's 11 a.m. and everything looks bullish. SPX looks great. You buy zero DTEs calls. You're expecting a breakout, but then you see a big gamma wall ahead, and actually dealers are actually hedging around these levels. And also, if you use our intraday gamma models, you also see an increase in negative gamma, right? So what happens is that SPX does not break, is chopping sideways, and your calls actually go to zero because of the time decay. So you could actually use some of these models to understand when to get out of this trade if it's not successful, and when to get in and how to react. Another very good example is Friday OPEX. We talk about this all the time. It's typically the biggest zero DTE day of the week. Most traders sell condors because they think that, SPX always pins on Fridays, right? It always pins around this level, right? But then what do you see? You start seeing that, dealer positioning is changing, negative gamma is piling up, and also the volatility surface changes. So you see that the pinning effect might weaken, and instead of selling into those narrow strike, you might want to increase your range, reduce your size, and use a better risk management, right? So the idea behind it is really that you can actually use data to have a successful strategy at selling zero DTEs. Zero DTEs does not have to be a casino, and with the right data, you can actually structure it, and it can become an opportunity for you. So now let's go over some of the things that we provide for you guys, and then I'm gonna also answer some questions. All right. All right. So first, within our dashboard, and we're going to look at SPX. We provide you with all expirations. So we provide you with our net gamma exposures and our gamma levels. Those are really the largest strike where we see the biggest market reactions. But we also provide you with the zero DTEs data. So this is a very, very important thing. And you can access zero DTEs levels on MenthorQ via our dashboard, via our integrations. We're going to show you that in a second. Then we can also look at our one-day expected move indicators. So if you look at SPX today, a very important data point is really how big of the move can we expect, and what's the one-day expected move for SPX. And this is our proprietary model. So today we were here at 6,553 for the lower move, and then we were here at 6,659, right? Why is that important? And we're now going to go into into our backtesting. So within your academy and within our wiki section, you can actually find our backtesting results. So we can go into our gamma levels, and we can look at the success rate of the one-day max and one-day minimum. So if we look at SPX, we are looking at 4 years of history. The success was about 87% for the one-day minimum. So the price the next day on 87% of the days closed above the one-day minimum, and the price for the next day closed below the one-day max on 85% of the days, right? Stayed within the range on 73% of the cases. That's why if you are trying to sell iron condors, or if you are doing ZTEs, you need to actively manage the structure. You cannot just leave it there sitting and hoping that the market will not close within those ranges. Then let's go back to to our dashboard. We can use the matrix for many, many different things. So for example, here we can see how much gamma and how much delta and how much open interest is expiring at each of the different expirations. So we have a big OPEX we mentioned on Friday. 38% of gamma is expiring, 32% of DEX, and 23% of open interest. If you then look at, for example, the VIX, let's see if I have the VIX. Again, we were showing that today is VIX expiration, and about 78% of negative gamma has expired on VIX. So again, when you go into some of these days, you need to pay attention to this data, because there are good chances that the market could actually move very, very fast. Then I also look at our screeners. So what I do normally in the morning, let's go back to here. I always look at the asset that I've seen the highest positive change in gamma. So for today, these are the assets that have shown the highest positive change in gamma. So whether it's stock, ETF, or index. And we can also see the highest negative change in gamma here. We have a screener for that. So coming into today, we see that SPY and SPX saw a big decrease in positive gamma here, or a big increase in negative gamma, sorry, and the QQQ as well. So again, this can be very helpful, and we can go and see again, if we look at SPX, for example, also how this has changed here. So you can see the amount of gamma that's been removed or added. So we've seen an increase in negative gamma here for this expiration. So very, very important. Overall, we've seen an increase in negative gamma by 332 million for SPX. The other thing that we always want to look for is then, can I go and look at intraday positioning, right? So let's go into SPX intraday. data, and let's see what's happening today. So first you have the NetJax 0 DTEs. So this is showing you the biggest levels for the zero DTEs options only. So again, if you're trading SPX Iron Condor, you want to look at that. This is showing you how this has changed, but the more important one are the JAX difference as we were showing before. So let's go back to the beginning of the day and let's see what happens. We have 14 snapshots per day, every 30 minutes. And then basically you can kind of see things that are happening. So we open with a very strong positive gamma increase compared to the previous day. We then go into a very big negative gamma environment until 11. We're still 11:30, so we can go in the chart. We can see how this moved here. So here we are 10, we are at 11. We're still in a strong positive negative gamma or negative move, and then things start changing at around 12, between 11:30 and 12. So now we are here. Things start changing, so the market is coming down. We are also approaching a big put support level. So now kind of like we're seeing a change in the trend. So here you're seeing, like, again, we went here and then now we are waiting and see what's going on. So here we're now chopping sideways right here. Yeah, so the key here is, again, those gamma levels, those position and intraday flow can really be a good tool for users who want to be selling or buying SPX 0 DTEs options. So I'm going to pause here. Let me know if there's some questions, and then we're going to move into the next. And sorry, guys, for keep you waiting. I think this is very important. All right. Next, we're going to quickly over swing traders and position traders, right? So now let's talk about swing traders and long-term position traders. These are really different from day traders or intraday scalpers because they actually might. So if you're a swing trader or a position trader, you actually might not be glued to the chart. You might actually look at the data once a day, and basically you don't have time. So maybe you're working and you don't have really enough time to potentially look at the market every day. So we still have a solution that can be very, very important. So for swing traders, the biggest challenge is that you're getting in too early and you're stopped out before the real moves begin. Or you get in too late and you chase the trend. And basically you don't really adapt to volatility shifts. If you're a position trader, you're not trading every day, but you're holding your position through big macro regime changes without actually realizing that the risk has flipped. And again, you're confusing low volatility with low risk, and you don't account for institutional flows that could change the situation of the asset that you have in your portfolio, right? So very, very important. So the other challenge is that swing and position traders usually treat the market as static. So they set a fixed stop, fixed target, and assume that the market is always the same. But the truth is that the market is dynamic. Volatility changes, flow shift, and position changing. So if you are not adapting, then you're basically, again, trading without a context. So let's go through a very quick example. And you are long Apple as a position trade. Volatility is low, and everything looks good. Price action is stable, and everything feels safe. But then you open up the MenthorQ dashboard, and you see that implied volatility is actually getting higher. So it's actually increasing. The Q score option, as we showed you before, goes from bullish to bearish, and we see a big negative positioning, and dealer gamma is turning into negative. So on the surface, just by looking at the chart, everything looks good, but underneath, market is actually looking very fragile. So we see a headline, a flow shock, it's Apple, and we are selling off, and your position takes a big hit, right? So with MenthorQ, again, you could have monitored this. You could have seen the calm before the storm and either hedge using options or maybe rebalance your portfolio and protect your capital. Next example is you are long Microsoft and you're looking for a swing trade. The move has been strong, so you're tempted to take profits early, right? So you're making good return, but you actually want to take profit because you don't want to risk to lose money on your trade. Again, what can you do? You could actually use the MenthorQ swing trading levels to potentially look for an upside target that has not yet been reached. You could actually use the Q score. And if you see that we are bullish on both the momentum and option score, then that could be a good signal for staying in the trade. Or you could also look at the skew to understand if we are in a call bias or sell bias environment, right? So instead of cutting your winner short, you can actually hold your trade with confidence. And again, using data to potentially trade and better manage the risk. So here is really what we can do for swing traders. So swing traders struggle with timing. MentorQ can actually give you some levels, some signals, some entries and exit. Position traders struggle with understanding what's going on and what's moving the market. So they lose money sometimes because they don't really understand risk. So again, this is really how you can actually trade like a professional, not guessing, but actually looking at data and how to use the models that we provide, right? So now we're going to go into a short example, and then I'm going to close it up with questions because we have FOMC coming on very soon. So I don't want to take too much of your time, guys. All right. Okay, so we're going to look at a couple of examples. So we're going to look at Tesla again. First thing is go again with the Q score. So we are seeing that we're in a very bullish bias on Tesla, both at the momentum level, at the option level, and we also see a positive seasonality score as well. We want to monitor our net gum exposure. So we want to look at the whole option chain and we want to see where the biggest levels are. So we are now targeting 450. We need to be aware of also this 400 level here is very, very strong. And also we have to look for our gamma shift, which is at 352. You can also look at different expirations. So you can also see how this moves throughout the chain, right? Very, very important. And then we want to look at our swing model. So we want to look at where the levels are. We want to look at the success rate of the models to potentially either build a position or manage your position. So if you are already in a Tesla trade, you could use this level to potentially use them as target. So let's say that you are in a long-term position on Tesla and the price goes to 458. On 73% of the cases, the price moved lower 5 days in the future. So this could become your target and you can see how that can be respected there. If you then want to play the stock with more like advanced strategies, you can look at the volatility risk premium. We see that is very high. So implied volatility of Tesla currently is very high compared to the historical shifts. So if you are comparing implied volatility with historical volatility, the VRP is actually at probably one of the highest level it has been over the past 3 months and maybe longer. So again, just monitor that within your volatility, and then again use the Q score to potentially look for trade ideas or potentially look for managing risk. So for example, another example is, let's go back to CRM. If you were holding CRM in your portfolio, then you can now see that we are in a very, very bearish environment coming from the option market, coming from the momentum, and you could use also these levels as your levels. So if the price were to breach this 229 level, then we are in a really dangerous zones. If the upper band resists, then maybe we could actually flip to the upside. And if we see positioning change on the next few days and weeks, then we can see how we can maybe the narrative has changed, right? If you look at the volatility, we're now in an undervalued IV stage. So the implied volatility and the volatility risk premium is actually quite cheap compared to the past 3 months. So maybe buying premium could be a better strategy than selling options in this case. Right, I'm gonna pause there, and I'm gonna ask some more questions, and then in about 5 or 10 minutes, we're gonna be live again on our Discord and stuff to go over some of our tools for FOMC. So, guys, if you have any questions, please send us an email, info@mentorq.com, and yeah, good luck for today. Let's see what happens, and we'll be back tomorrow and next week.